Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The fallout from the Silicon Valley Bank debacle continues. Regional banks are bouncing today, but most are still down more than 30% in the last 2 weeks alone. Now, not surprisingly, the ETF industry is moving very quickly with new products to address all the confusion. In response to the banking crisis, tomorrow, Roundhill will launch a new big bank ETF. It's actually called that, folks. Dave Mazza, Chief Strategy Officer at Roundhill Investments, joins us now with more, along with Greg Bassick. He's the CEO of Access Investments. Todd Rosenbluth, my old friend, Director of Research at VettaFi, also joining us. Dave, congratulations. You moved with stunning speed to capitalize on this banking crisis. Tell us about this big bank ETF launching tomorrow. What's in it?
Yeah, Bob, you're absolutely right. There's been a lot of question marks about the financial sector. And what we've been hearing from investors for years is looking for opportunities for more precision than is available today. And what the big bank ETF is, it's exposure to 6 banks, the largest and most liquid banks in the U.S. And so that's Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, JP Morgan, and Wells Fargo. And again, these are the banks that actually stand to benefit from this turmoil, and that we believe actually are going to offer investors potentially the opportunity to do better than what we have seen, of course, with the regional banks today.
And I see you've got here, we're putting up a full screen here, you have an expense ratio of 0.29%. And that expense ratio compares favorably, Todd, with the expense ratio of the bank ETF, the KBE. I think it's 0.35%. You know, Todd, I really marvel at how quickly the ETF industry can capitalize on these hot investing trends. It really is something. Remember, we saw this we've seen this many times. We saw this with pot ETFs. We saw this with thematic tech ETFs, with cybersecurity, social media. We saw this with crypto. And investors pile in when it's a hot topic, but these hot topics often underperform a year later. So explain to us how we should sort of look at these products. It's marvelous to see how quickly the ETF industry moves, but should investors necessarily jump on everything like this?
So no, investors shouldn't just jump to this just because banks are in the news and both the good and the bad that comes with it. You really want to do some due diligence, make sure those 6 banks that Dave was talking about is important. At VettaFi, we're seeing greater interest in financial ETFs in particular. In fact, from a sector ETF perspective, more than 50% of our traffic on our website was towards financial ETFs, really? Over energy, over technology. But you want to make sure that you're researching for the right reasons. You could either be buying, you could be selling. You shouldn't just go into financials just because it's making the headlines. In fact, that might be a reason of risk why you may want to steer clear of financials because you have it within your portfolio.
I get this all the time from our viewers who, when we talk about IPOs on the day, and then, of course, they pop on one day, and then 6 months later, they're lower. Dave, you know what I'm talking about. Why is now necessarily a good time to invest in banks, given all the increased regulation and higher costs?
Well, it's interesting. We don't believe that investments in the banking sector is actually a trend, right? We're talking about names in this particular case that are mega caps that actually have exposure and to diversified business lines, whether that's traditional deposit banking in the case of Bank of America or Wells Fargo, or really leading investment banking franchises in the case of Morgan Stanley and Goldman Sachs. But what's interesting here is that a lot of firms had calls on regional banks doing well into the year. I don't think many could have predicted the turmoil that we're seeing today. But in a crisis of confidence, where really investors are going and picking and choosing any areas of weakness, whether that's Silicon Valley Bank or Credit Suisse, the idea that investors are now going to have the opportunity to gain that financial exposure without the dilution that they're going to get potentially with other financial ETFs, I think is really exciting. And that's one of the reasons why we looked to bring the big bank ETF, a big B to market tomorrow.
You know, Todd, the investors in these sector bets, banks or energy, whatever, I think it's a good time to realize that they may be more exposed than they think of to certain things. For example, just this bank thing. Value is the largest, banks, financials are the largest sector in value ETFs. Vanguard Value is 20% financials. iShares S&P Value is almost 20%. So investors, if they own certain sectors, even if it doesn't say financials, they may be very much exposed. This is sort of like a teaching moment. My point is to explain to people understanding what you own here.
That's right. So financials is one of the larger sectors within the broader marketplace, but in value ETFs in particular, it's the heavyweight. That's where people tend to turn undervalued companies like JP Morgan, Bank of America. So with these ETFs, sector ETFs in general, and more concentrated ETFs, you really want to make sure you want to overweight. That now is, according to you as an investor, is a great time to be overexposed to these companies. These are more concentrated. That comes with the pluses, that comes with the minuses, but make sure you know what's inside your ETF.
You know, Greg, I want to bring you in here. You run a suite of long-short ETFs, including a very well-known, the long-short ARK funds. You run the Short Innovation Daily ETF with the SARK as a symbol there. That's Short ARK. And you run the 2x Innovation ETF, which is TARK. That's long ARK 2x. How can ETFs be used as a tool for those who have high conviction? You run high conviction ETFs, it seems to me.
We do, and actually, you know, it's interesting with this latest development, you know, with thousands of startups and small high growth companies really driving innovation, having received financing from Silicon Valley Bank and others like it, this really could be a harbinger for concern around the ability of these kind of innovation driving companies to get financing going forward. So, you know, with that potential chilling effect on financing of tech driving companies, to your point, that Access Short Innovation ETF, the SARK ETF, we've seen sentiment play out around that. For example, in just the 7 days after the Silicon Valley Bank news broke, we saw an 80% jump in trading volume versus the 7 days leading into that news. So we are, in fact, on that side of the trade for those with high conviction concern around how this could impact startups and smaller high growth businesses that are driving innovation. We are seeing that take place. And then the TARK ETF, the 2X Innovation ETF, same thing, over 50% jump in trading activity in that 7 days following the Silicon Valley news breaking versus the week leading up to it.
So this makes some sense to me. I mean, to the extent Silicon Valley Bank is a whole play on the startup economy, then, and to the extent Cathie Woods is a play on the startup economy, these kinds of ETFs, the SARK and TARK that Greg represents, do make sense for people who have high convictions with the understanding of what goes on in these ETFs.
Right, that's important too.
Yeah. The daily reset and everything.
Two times leverage or shorting obviously comes with greater risks than investors probably fully appreciate when they just see the price performance chart that we showed up on the screen right now. And this is obviously a play off of ARKK, which has seen really strong performance in 2023. And actually, we saw people rotating towards it during times of uncertainty because it's a risk-on way of getting exposure to the growth economy. But of course, concentrated bets are concentrated and come with risk on its own. So you just want to make sure you know what you're getting and what you're not getting.
My point is that what he's saying here makes some sense to me. To the extent Silicon Valley Bank was a play on the startup economy, and you have a situation here where all of this disrupted what happened with Silicon Valley, disrupted perceptions of the startup economy. Then Greg talking about higher volumes in SARK and TARK, which are Cathie Woods plays on startup economy, essentially. That makes a lot of sense. You would see those kinds of volume plays.
It does make sense. And again, that's the benefits of the ETF and the liquidity that comes with it. We're seeing volume spiking in areas where investors want to get exposure to it. And there's now an ETF vehicle, both long or short, in addition, or 2 times long and short, in addition to the traditional ARKK product.
Yeah. You know, Greg, you're also, speaking of concentrated bets, you're also a big mover in single stock, leveraged and inverse ETFs. But aside from some trading action in the Tesla Bear ETF, maybe we could put that up again, and maybe the NVIDIA Bear ETF, the volumes that I see in these single stock ETFs are pretty modest. Well, can you parse that for us? Why is that happening?
Yeah, absolutely. And, you know, in our experience, it's consistent with any new innovation. So to your point, our TSLQ ETF, you know, has been very strong, 100 million a day in terms of volume. NVDS, which is a short NVIDIA stock. Same thing, we're seeing some growing momentum there. But when I say it's consistent with any new innovation, a lot of it is about education and visibility. When there were other new innovations in the ETF market, many of them took a little more time until investors understood that these were tools out there for them. Big picture wise, I would also share that, we are pleased with the launch of the family in a relatively short amount of time. Overall, we've raised about $250 million in assets in the fund family. And to your point, there's been a little bit of a difference in terms of which ones were faster out of the gate. But we're very bullish on the long-term growth of this space in general.
Well, Todd, this isn't a big surprise. I mean, people want to play Tesla because it's got high volatility and it's got a man, Elon Musk, that people love to play long and short. NVIDIA is a high volatility, high conviction tech stock, but Pfizer, really, what's the use case there for people getting really excited about Pfizer? I mean, it's a low beta stock, so I'm not terribly surprised by any of this. Are you?
No, I'm not. I mean, I think there was a concern within the ETF industry that we would see a single stock leveraged and inverse ETF universe for the whole suite of the S&P 500, and there just wasn't a use case for that. Tesla is a company people have in their portfolio, or they have conviction on long or short, but very few companies fit that same criteria. Apple, maybe not. Meta, but most of these companies, you really want to have, you could just own the individual stocks. And ETFs, of course, you get the benefits of diversification.
Greg, on SARK and TARK, the Cathie Woods long and short ETFs, who actually uses them? I know it's popular to say, oh, professional investors use this, but do we have any evidence, like hedge funds use them, and in what cases? Are they just owning them, or are they using it in conjunction with another strategy of going long or short options or something? I'm just dying to meet somebody who will come on and say, oh, I use these all the time, and here's how they use them. Do you have any insight into that?
We do, and let me share that with you. Just one quick point on that last comment, though, about the other single stock ETFs. One other data point I just want to share is that where we have seen, with respect to those other single stock ETFs, we have seen a nice pickup in volume, for example, around earnings season. So for something like Pfizer and Nike and some of the others, it is notable that we have seen jumps around those use cases like earnings and other company developments. That's why we remain bullish on that family. With respect to who's buying them, we are seeing that it's largely the sophisticated traders. But what does that mean? It's hedge funds. It's a lot of institutions. These are big position takers often that are long, for example, on the underlying stock in the case of Tesla, but want to trade around those news investments and might have a very high conviction short-term bet. And for investors like SARK and TARK, same thing. These are large, sophisticated investors that tend to be, in a lot of cases, long disruptive technologies and looking to have a high conviction short bet, or the opposite. They're looking to go 2x around news where disruptive technologies and the real innovation drivers, where there's some developments that have come out both economic or market-wise or industry-specific, where they want to take that short-term high conviction bet.
Yeah. Okay. Let me thank you for answering that. So it looks like a lot of people are using, they're long the stock or long the ETF, and then they're using these for short-term convictions.
As if it's a covered call.
Yeah,
like if you
essentially,
just being able to do it in a more efficient manner than trying to use the options themselves.
Yeah, good point here. Dave, I want to bring you back in here. In a move, speaking of Cathie Woods here, you're also planning to release a suite of ETFs with concentrated exposure outside of this big bank ETF. You're going to launch a big tech ETF, a big airlines ETF, a big defense ETF. I'm sensing a trend here. Why are concentrated bets a hot topic now? What just made you decide to issue these, and when are they coming out?
Look, Todd said it well. I'm a big believer in knowing what you own, and in this market, that's more important than ever. If we look at the largest financials ETF, XLF, which is a great fund which has serves great purposes, if you look at the exposure in the top 5, there's now names like Berkshire Hathaway, Visa, and MasterCard. And of course, they are financials as defined by GICS, but they're not necessarily banks. And the same could be said about other sectors, whether that's technology, airlines, or defense. So our idea is to bring investors the precision that they're looking for to gain exposure to that narrower number of names. Now, of course, there could be environments where you want the smaller companies. There could be environments where you want non-profitable tech companies. But in this market, there is a flight to safety. People are bidding up some of the larger names, especially in the banking space, because they may be the beneficiaries over the greater regulation coming there. And that's why we're bringing Big B to market. The others we hope to have soon, but you're absolutely right. The intention here is that Big B is not just a standalone opportunity, but the idea of it being a leader in a potential suite down the line.
So again, Todd, this the hot topic. We're back to this hot topic issue. All of a sudden, concentrated sector bets seem to be the ETF, hot topic du jour here. Is there a use case for concentrated bets?
I do, because I don't think it's being used individually. I think what people are going to use these big ETFs, the Big B for the banking one, or aerospace, or airlines, or what have you, is going to be in complement to a broader S&P 500 strategy. So you own the iShares S&P 500 ETF, IVV, or SPY, the Spider S&P 500 ETF, or so forth, and you can use more concentrated ETFs to be able to augment your exposure. So if you want more in the banking space, or you want more within airlines, the same way that you might do individual stocks of favored names, but now you're getting the benefits of 5 or 6 of these companies to augment that. I think that makes sense to that, as opposed to just trying to do it themselves. Yeah. And we're seeing this year that active management and actively managed ETFs in particular have been relatively popular in complement to an existing core strategy.
Well, we talked about, of course, what the whole FANG stocks, and essentially, I don't know, Dave, can you tell us what's going to be in this big tech concentrate? How many stocks are going to be in this?
Yeah, so for the big tech, it's structured in a similar way, and it's the 5 stocks that you probably know and expect.
We know who that is.
Yeah, exactly. Your Alphabet, your Amazon, your Apple, and your Microsofts of the world. So this essentially it's your exposure to mega cap growth names, whatever is the topic du jour. And I should have said Meta would be in there as well.
Yeah, it's FANG. You're sort of trying to reproduce what we used to call FANG. My colleague Jim Cramer invented the word FANG.
But you can't get that right now easily with an ETF. Just those 5 or 6 stocks. Either they're in a different sector.
Well, there's Vanguard big cap tech, right? There
is, but it holds a few other things. Yeah. It holds a few other companies as well. So if you really wanted to make a call on just those 5 or 6 companies, there's an ETF that soon is coming, it sounds like, from Roundhill. It's not coming tomorrow, like the banking one, but there'll be a future ETF that's out there.
You heard it here, folks. Big ETFs coming, concentrated bets. We're on top of everything. That's why I got Todd here and my other friends here. So you heard it here first on ETF Edge. That does it, folks, this week for this week's ETF Edge. My thanks to Dave and to Greg and Todd. And we've asked Todd to stick around on the ETF Edge podcast right after the show to talk more about big trends in ETFs for the rest of the year. And remember, you can see all of our shows on our website. They're still there, folks. etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.